Welcome to the Thefynprint. I am today with Sandeep Tandon of Quant Mutual Fund to discuss markets, mutual funds, and a new category called SIF that's looking quite interesting. So, first, Sandeep, if we can begin by looking back at the year gone. We are at the start of 26, but 25 had quite a few surprises. The biggest one, of course, being gold and silver. And you've captured a lot of that in your multi-asset fund.
Yeah.
You are 15% in silver, 5% in gold. Even now, the asset allocation there.
At peak, we were 30% silver. We are still 13% silver.
Correct. So from 30, you've gone down.
Yeah. Very recently, last week we have cut down.
So I was looking at your multi-asset fund and comparing it. So that has an AUM of around 1500 crores. And I was comparing it with your possibly your largest scheme, which is small cap, which is 30,000 crores almost.
Yeah.
And the 5-year return is almost the same. 25 here, 26 there. And the volatility on multi-asset is much lower. The standard deviation is much lower. So for most investors who don't want to take adventures into mid and small, should this be the path going forward? That stick to a multi-asset fund, let the fund manager take those calls.
Okay. So Neil, as you understand, we believe in very active way of money management.
Yeah.
And the beginning of 2018, when we took over this company from Escorts, and I think in 2020 onwards, on multiple forum, I said, which is the one scheme will be the flagship scheme, because this question come flagship scheme.
Yeah.
Today flagship scheme is linked with the AUM.
Correct.
I don't link that way. I said in 10 years later, multi-asset will be your flagship scheme. And I tell you why. Because this is one scheme which get me maximum flexibility. On asset classes flexibility, stock sector obviously is there, but asset class rotation is something beautiful. Another important thing is about the taxation. Okay, if you obviously keep it for more than 2 years, you get equity taxation.
Correct.
Route, which is not the case with your other ETFs also. We don't get that benefit.
Correct.
Now the beauty is that instead of running like 1/3 commodities, 1/3 debt, 1/3 equity, most of the houses runs in this manner because people don't want to take a call on any asset classes.
Right.
It's a diversified portfolio. We as active money manager, we do a lot of macro research and predictive analytics. We believe that we can time it asset class rotation better than others.
Right.
Okay. And this we have demonstrated in last 5 years, though despite it is one of the best performer in that category, even in 5-year basis also, or 1-year basis also.
Yeah.
But we don't have that much desired AUM what ideally this fund should have. Okay. Now the way I look at is that instead of you choosing this in this manner, now the beauty of inflection points, okay, really help. Now if you let's go back and recollect beginning 2025.
Right.
We were the one fund house who said that silver will outperform gold.
Yeah.
Okay. And we sold entire gold from our portfolio, and we were running only silver in precious metal.
And how much was that?
Peak 30. Okay.
So start of 25, you were at 30%.
Yes. Okay. We in phase manner it moved up.
Right.
Okay. So we started increasing our exposure from end October 2024, and if you go back and check our predictive analytic note or the book which was published in 2018 called Being Relevant, in the precious metals page, I have written very clearly that the last quarter of 2024, massive bull run in precious metal cycle starts. And use the word massive bull run. Okay.
Right.
And you saw exactly around that time it played out. Okay. Now to take a conscious call in the beginning 2025 is not gold, it is silver. Okay. Now that where a majority of the funds were in gold. Okay. After silver rallied, people started nibbling into it. Okay. They were never participating into that. It's a mindset game. Now we as a house who specialize in the inflection points, we got it right. Now if you ask me now, too much hype is there. Okay. If I have to say in silver, gold, we think we are in the fag end of that characteristic of trade which is speaking out. Now I'm extremely bullish from long term. I have been saying that you should own 15 to 20% precious metal in your portfolio if you are a long term investor and you believe in that. Depending on your, some people have ornaments, some people have bars. So depend. A lot of people in traditional places have their bed and table also made of silver. Historically. Okay, so it depends on how you, because in our Hindu mythology we say Chandi means पानी तत्व.
हाँ.
Okay, I have heard from my dadi.
हाँ.
Okay, पानी तत्व है.
हाँ.
Okay, at least in our house I have heard from my childhood, ये
हाँ.
पानी तत्व है, इसको hold करना है. Okay,
हाँ.
and lot of people in you go back in the history of ETF and silver moves are very volatile. It crashes like 80%. Okay, so people are not able to hold it. So it is there a back of the mind. Now the way if I have to interpret 2026, I think from a very medium term perspective, we are in a final leg of silver peaking out and gold peaking out. Okay, that's the reason around 91, 93 levels, we have cut down half of our silver position. I cannot cut down 100% because I'm not supposed to hedge, and hedging is options are not available in that sense. Okay, which we can do it in our SI product.
You can't go below 10%.
Yes, so we have to maintain. Now, what I will going to do, we have already cut down, we are going to cut down further in next 7-10 days whenever we think the cycle is peaking out. Okay, we'll cut down and wait for an appropriate opportunity, because this year we think precious metal will behave like crypto has behaved in the past. So you will see this move, this sort of moves. Okay, be prepared for wild swings in precious metal space, particularly in silver in 2026.
Can you do other metals?
Theoretically speaking, yes, but what happens, the challenge is that our most of the time custodian, clearing houses, they are not geared up. Okay, and we don't want to deal with a very small custodian or clearing services because of discomfort, nothing else. Okay, so our custodian, other big bank custodian which we use like HDFC or IC, they are not geared up. Now they are getting into some of these things, so we will look into it. And that's the reason we have delayed our multi-asset fund for the launch on the SIF front, you know. So once they are ready, life becomes easy. Okay. But it will happen, it's a question of time.
Okay, so I'll turn to SIF in a minute, but of course the other most common question I get in our community at the Thefynprint is about some of your largest funds, Quant small cap. They have been somewhat underperforming, and why is that? Like,
so Neil, I'll answer that. Okay, it's a very natural question, and it's a human psyche. You want to optimize on both the sides. In the bull run, you want to say which has done the best, and the bear market you say which has done the best. Okay, you can't be on both the sides all the time. That's the first point. Second thing you have to understand, we as a house run this entire investment process in a very mathematical manner. So we don't want to bring our personal biases into it. And when you run, you follow a process. Okay, every process has its certain challenges. Okay, nothing works 100%. Okay, we always say 28% time we are always wrong, 72% we get it right. Now, how industry work is very different. Let's understand that majority of the money managers here or globally will try to give weightage on the indices big time. They will try to be closer to the benchmark. So if you go and do a very detailed analysis, you will see 70-80% of their schemes are hooked to the benchmark. Okay, idea is very simple. Nobody wants to show massive outperformance, but nobody wants to show massive underperformance also. If your 70-80% is like index, then what you are playing with 20% or 30%. Okay, let's say 25% average. So with 20-25% average you are trying to generate alpha from that money. Where in our case, we try to generate alpha on 100%. We don't mimic indices. Okay, if you look at any parameter which measure that, whether it's R square or any parameter you look at, our correlation with the benchmark is actually negative. Okay, or it is not positive at least. Okay, so it will not match. Now we as a house very strongly believe we take active money management fees. Why should I offer quasi-passive product? Okay, and this is the failure of active money management. I'm very vocal about it. Not only India, globally. Let's understand 2008. Okay, till 2008, much before this Lehman crisis. This Lehman was the liquidity crisis, which was the first time world has seen. Before that, we have never experienced, and majority of the people was lost what to do. Okay, I have seen from 2009 onwards what people did. Instead of taking very aggressive view, people started mimicking the indices and says that I have closer to the benchmark. Now what happened, India was very tiny at that stage. Global market was very big, but let's talk about US. And that's the way from 2011-12, genesis of so-called passive product came into picture, because investors were even smarter than the money managers. They felt you are charging me active management fees and offering me a quasi-passive product or nearly passive product.
Correct.
They moved to passive, and that call worked very well globally. Okay, so people made money, big money. Now this is the typical mindset in a bull market. Everybody wants to participate and say I want to winner. So we as a house, what we do, see, it's a logical thing. You cannot capture each and every move. Okay, and nobody is so perfect in life who can tell you exact tops and exact bottoms. We are still able to identify better than others. Okay, now when we are trying to say that in a risk on phase we play very aggressively. When I say aggressive, in my global risk appetite, or let's say India risk appetite is rising, liquidity is rising, that's the easy phase of bull run.
Sure.
In that bull run, we will be largely deployed and actively churning the portfolio by booking profit somewhere else, participating somewhere, sector rotation, stock rotation, we do very well. We always say in a risk on period, generate extraordinary alpha. And risk off period, lie low, even you have to underperform. So in a risk off period, we will underperform. So we have to look at from risk on, risk off perspective. A lot of people don't say, don't understand this thing. It's a very nice way of marketing on confusing people. No, you have to understand how we operate. If we also start operating in a same manner, like a passive product, you will not find volatility in our products. But as a house, we are determined that we want to position our product. It's a strategy. So we got massive success also. From 27 crore to 1 lakh journey in 4.5 years. I don't think in this history of any mutual fund anybody has done that, which Quant delivered with returns across all schemes. That was the risk on period. Risk off period. And second, we also as a human being always say,
sure,
we don't have a God status, we also learn, we also evolve.
Sure.
The entire our VLRT framework I always talk about has built from mistakes. It's not like we have arrived from somewhere. So we always learn. Last year there were challenges we faced, the impact was very large, volume disappeared, how to handle that. We have created a ways of doing it, but it never happened overnight. It's a journey. Again, that is also a process. We have to live it. So if any investor comes in the market, we all talk about long term, 5 year, 10 years. I'm saying even let's say 6-7 years somebody is coming from market. If somebody is investing with Quant in 6-7 year perspective, he will always see a massive outperformance. But if selectively you say 1 quarter, 1 year patch, then obviously match will not match. But I always say if you say 1 year we underperformed, then why you don't talk about that 6 year outperformance or 5 year massive outperformance which you got in the past from 2020 onwards. Okay. So we have to look at it in totality, and it's
no,
a human thing. It's a human thing.
The irony is that people come into funds after they have done really well and then they see this painful period.
So Neil, I always say at the peak of bull run, risk appetite of every investor is highest and every investor is long term. Okay. Reality is that he or she is not. I always say, a lot of people say, oh, I don't have wealth manager, I don't know how to assess. I said very simple. Just go back and sit down and analyze your behavior. If you are old in the market, what you did in Harshad phase, what did you did in 2000 .com bubble, how you reacted in 2008, what you did in 2018, 2020, okay, what you did in September 2021, all key inflection points. Somebody says I was not there in 93, it's fine, but you were there in 2018, you were there in 2008. Okay, you go back and analyze. If you have not reacted and not exited at the bottom of the cycle, it means you are not long-term investor. Equity is not your cup of tea. You should remain in balance advantage type fund or debt fund or arbitrage fund. You should not come because you don't have risk appetite. It is your wrong myth and assumption that I also have, because surrounding is people are making money, so you also get excited.
I think this goes back really well to the first question, which is if there should be a flagship at all, it should probably be the multi-asset fund, because in periods like this, you also shielded people from that downside through your multi-asset fund. Just couple of...
But problem is that multi-asset as a concept has not picked up yet in India. Okay, because majority of the people says I'm willing to take risk. A risk means equity. Okay. The risk angle with risk adjusted return is when the best of the wealth manager don't understand. Okay, we write so much detail in our fact sheet with numbers to explain you, but lot of people will come with same a very elementary question, because the risk adjusted return thought process we have not educated. Now we all talk about absolute returns, maximum we talk about relative to competition or relative to the benchmark. We never talk about what risk as a fund you took and then you generated alpha. Okay, so if you look at our risk adjusted returns, one of the highest today. Also our beta is significantly low the way we run a lot of products. Okay. And it's a process. I think in next, as you go through a downtrend phase, people understand the importance of risk, and that's the way from a longer term perspective that SIF type product will give you a better understanding.
Okay, we'll come to SIF, but very quickly, there are two things that mark you apart from other AMCs. Apart from what you said about bull market outperformance and some of the volatility in bear markets, which is that you have quite a similar set of holdings in different funds. There's nothing good or bad, right or wrong. I'm just saying that's your style. And the other is that you have a conglomerate strategy. So at one point of time, I'm not going to make you opine on any individual stocks, but at one point of time, going by your historical fact sheets, you had a lot of exposure to Adani Group stocks and subsequently to
and Reliance also.
And so to Reliance,
and we do have a lot of exposure in other large conglomerate also. It's not only these two names. Sure. We have very large holding in L&T also. We have very large holding in ITC also. We are one of the largest shareholder of PSUs. Okay. So what happened again? People look at very selective because that sometime episode happened. So you link with that. See, our approach is conglomerate is not about particular group. I am a very hardcore, basic number driven. We come from very traditional school. We have never taught, okay, about multiple of sales or new benchmark which has come today, and people started looking into that. Very simple maths we look at. We look at the operating cash flow, free cash flows. We look at the what sort of ROE number you're generating and what you want to look at, what capex. Hard asset is very important thesis for us. If you have hard asset, I know you will sail through the tough phase. And when if the company which we are trying to identify, idea is to identify where operating leverage is high. If operating leverage is high and then somebody take advantage of financial leverage, those are the names which will be a biggest beneficiary. So it's a period which you have to believe, like we don't participate in most of the IPOs. We don't participate in new age company. Maybe as a house we don't understand. Sometimes you feel we are outdated, and I'm very openly telling you because you look like an absolutely idiot because what is happening, Okay, we have been taught in our college days, a branded company, you pay 2 times, 3 times, 4 times, 5 times, 4-5 times was the max. If let's say Glaxo bought Complan or something like that, or Boost, those are the brands you say I will pay 4 times, 5 times. Now you started paying to the entire conglomerate, saying that the enterprise, I look at the sales of these companies, okay, nobody generate cash flow. Promoter themselves don't want to say I generate cash flow. They say, boss, 10 years I'm going to make a plant burn, lot of new terminology we learned, plant burn it is, okay. Now if you say that, and you go and ask any sensible money manager, a lot of people have old people out here, what we look at 3 years, maximum 5 years. Average earnings forecast is 3 years. We look at 2 years, 1 year, 2 years, 3 years forward. 5 year, chalo, is today in the company in the capex cycle, so 5 years. Now, can you ask anybody to justify this valuation even on 5-year basis? Answer is no. And why to give such high valuation to IPOs? Because it's a very classic way of because illiquidity is there. When illiquidity is there, prices move. So everybody plays that illiquidity game. So there's no value out there. It's a various different reason people buy those stocks, and then you say, no, these are the companies which you look at. We are very vocal, and I talk very openly about it. Something which we don't understand, we don't invest.
Sure. Sandeep, now let's turn to SIFs. Can you brief us through what you've launched and what you plan to?
Okay. So I'll give you a gist of SIF first. Let's understand why the timing of this time SIF, and we are actually grateful to SEBI. Timing can't be better than this. Okay. Now, last many years we have seen easy phase of bull run. Okay. In India, it got over in 2024. We said July 24. Somebody can say December 2024 or September 2024. In an easy phase of bull run, passive product will do extremely well because their cost structures are very different. That's the first point. And obviously, equity, mid, small, because the risk on cycle, mid and large will outperform decisively, and that's the way we got a lot of money. Not only us, industry also got a money. Now, if we believe that easy phase is over, okay, the way I said in July 2024 for India easy phase is over, we are saying in January 2026, global easy phase is over, and particularly US. US market decisive. We are still in bull run, decisive bull run, but easy phase of bull run is about to end in January 2026 itself, or first quarter of 2026. I will say January 2026, because we are seeing signs of complacency. People have massive complaints out there, and it's just a euphoria which is getting built. I'm not calling it maniac, I'm not calling it a bubble, it's a euphoric phase which is there. In this type of phase, when reversal happens, okay, then a product like SIF plays a very, very important role. Okay, let's say example. Okay, what SEBI is allowing us. SEBI is saying that to protect your downside, and you want to suppose generate alpha through shorting of stocks. Okay, we are giving you a 25% naked short opportunity. Okay, now a lot of people are linking that derivative means more risk. Okay, derivative is a risk instrument, so we have to understand leverage and derivatives. Derivative products without leverage are good risk management tool. Derivative product with high leverage are risky products. So that's the one myth I want to showcase, that people say derivative means risk. Okay, no. SEBI is very clear. You cannot increase your exposure by shorting and going long. Okay, with a cash cannot exceed more than 100%. Your gross exposure cannot be more than 100%, which means as a mutual fund, we are not allowed to take any leverage. So that means the unwarranted perception about risk is a risky product is gone away. Rather that, I call it a beta management product. Let's say understand the problem, and I'm making it, instead of getting into most complex thing, I'm making it simple thing. What is the challenge of the industry? Challenge of the industry is everybody wants to participate in the mid and small, because that's the time you make maximum alpha. So in bull run, everybody feel very happy about it. When bear market, because the beta is very high, the percentage decline is very sharp. Look at today, if even look at, we are hardly few percentage away from all-time high. But portfolios have been butchered. Okay? Because majority of the people in the individual capacity also have very large mid and small holding, because alpha is there. Maximum alpha is generated here in last many years. And in, even I still believe in long term, again the alpha is there only. If you have any given time, you come to the market from a 10 years perspective, 5 years, if you put even 6 years and you come at the peak of the cycle, still you want to make money, provided you remain invested. You should not get capitulated at the bottom of the cycle. This is the problem which a lot of people faces. Okay. Now coming back to SIF, when you say 25% naked short option, it gives me a flexibility of reducing the beta. Okay. So let's say if I am running 100 rupees portfolio and 25% short, okay, by default, my beta is 0.65 only, or 0.75. Okay. So assuming I am fully invested and I am 25% short. So I have cut down beta by 1/4. So I call it SIF as a beta management product, and which is very simple for people to understand. Let's say example. Okay. Now a lot of people have mindset, oh, SIF will not fall. That's not the case. Okay. Let's say example, yesterday was a very bad day in the market. Okay. Mid and small was 2%, more than 2%. Okay. Even our schemes on the mutual fund fell that. Okay. But our small cap fell by 2.25 or 2.3%, something like that. But our X100 fell only by 1%.
Your SIF example.
SIF. Okay. Now people have, it should not fall altogether. No, it has fallen less, and that is the math which people have to understand. The market has fallen sharply. The impact was here 50% only. Okay. Because some portion was partially hedged, and somewhere we have either shorting thing, we are generating extra alpha by shorting, and still we have not gone completely 25% short. Okay. This fall was very brutal and very swift. Okay. So, and when any product is new, it's a mindset game. Okay. It takes time even for the team to adjust, system to get adjust, clearing, custody, everybody takes some time, and we also don't want to go suddenly, okay, and say I have done it. Okay. No, there is no compulsion. SEBI says that you have option. There is no compulsion to do it. So we are also evolving. It's an evolving process, and it is evolving beautifully.
Sandeep, in the SIF space, what I've seen evolving in the industry as a strategy is partial use of traditional arbitrage, which is shorting of futures, and partial writing of call options. Is that roughly the architecture that you follow, or you
No,
do?
see, let's understand. Today, let's say whatever the products available now, 2-3 more are coming. Majority of the fund houses launch hybrid product. Okay, and in hybrid product, except us, everybody is focusing only on the arbitrage plus or FD plus. Okay, people are very clearly low risk type of product. Okay, now it's a conscious call we have to take what we want to do. Okay, we were running this product as a BAF long shot. In BAF, what you do, 30%, 40% equities,
Correct.
remaining are arbitrage.
Unhedged and hedged.
Okay?
Correct.
So at your given time, your equity exposure never crosses 40-45%. Depending on scheme, I have seen 35 to 45 is the area most of the schemes are.
Right.
So we are also doing exactly same thing. 30-35% exposure I am maintaining on the equity side, and remaining through hedge option, arbitrage option, or call right option. Okay, we still not got that all out in call option because we were expecting at least in January to market to have a pullback and we make new high time, which it made, but it was just a small trailer blip and then collapsed. Okay, we were trying to time it slightly more better, but unfortunately sometimes you don't get every moves right.
Okay.
But what is very important, yes, it's a good strategy, but it's a conscious call. I have a very different view. Why should I just make this product as an arbitrage product? Okay, arbitrage plus. A, I am cannibalizing my own arbitrage product, and then everybody says I am going to move to arbitrage plus. B, you can convert any of your equity scheme to make something similar to arbitrage plus. Okay, so it does not make it looks nice right now because markets have fallen and you have generated positive return because of small positive, but positive. So people feel more happy that this is a good product. But again, I am not saying that everybody has own perspective. Even our sales people say we should follow what industry is doing because that's the way industry goes. So from a business perspective, answer is yes, that makes a lot of sense because the entire industry is moving in that direction. We have to take a conscious call how you want to. We always say we are active money manager, so we will run it the way we think to optimize 25%.
Sure, Sandeep. If we can focus first on BAF plus and then on X top 100 or SMID plus. In BAF plus, what is the model?
In BAF plus, our model is we do take 35% exposure, okay, and obviously we also run 25% we have to keep debt which we are running. So we have InvITs and debt sort of as a combination. So we are InvIT around 15% right now. InvIT and REITs, if I am not wrong, is InvIT only. Then remaining thing what is left is some amount of call writing we can do. We have not actively used up to call writing up to that because Wall's point was very, very low. Okay, India VIX was hardly 11%, 9%. So Wall point was low. When Wall expands, okay, then it makes a lot of business sense to do it. On both the sides we can do it.
The premiums are not very high.
It was not very high. So unless you want to do for just 1%, we felt it was not a great strategy. So today you feel very nice generating small alpha, but with 25% shorting opportunity, I just want to make two tiny returns, two tiny opportunity. On a relative basis, it looks right now very nice, but in long term, it will not.
Okay. Finally, let's turn to X top 100. Over there, you don't get F&O beyond the top 200 stocks. So you have to write imperfect hedges. You have to short the index, for example. That creates, so what is the strategy there?
So what we are trying to do is that, let's understand, SMID as a category is not there in the mutual fund. So which is grateful to SEBI again, where SMID category was brought. Together you can participate mid and small together.
Correct.
What is our thinking is that we are still running like a small and mid category, how you run with similar return expectations, but we call it long short SMID.
Sure.
Okay. When I say SMID with shorting option. Okay. What it gives me, that 25% shorting of exposure in the SMID gives me some additional comfort. Okay. Now, obviously, you cannot short the large caps name. As of now, SEBI is not allowed. Maybe even this it might happen. Or we have asked regulator to increase the number of stock from 213 stocks to maybe 500 stocks over a period of time. That makes a lot of sense. Our strategy is very simple. We will keep some 20 odd percent strategic sort of thing, whether those stocks have F&O or not does not matter. If we think this 20% stock can give me sizable return over a period of time, the remaining 80% stock we will flip. So we are saying tactical long and opportunity short. We'll try to take advantage of that. Okay, if need market turns extremely bad, and then we have obviously option to hedge those product. But as of now, thinking is that run the product the way you select mid and small cap, but with a 25 shorting. So idea is that how you demonstrate that you have a good edge on shorting side. Okay, that is something which will take some more time, because see what happens today. Oh, you are long in the market, and if you have a loss, you are okay because you are long-term investor. Prices can correct down. I have seen in my own team, when you are short and stock rallies, people think, oh बाबा loss हो रहा है. Okay, when I ask them, बस long पे loss होता है तो tension नहीं होता है, short पे loss हो रहा है because they are not used to it. Okay, so I am saying for us, and ultimately we are all human beings first. We are going through that phase. When you start understanding, I say you have to look from insurance perspective. This is a view based. We are doing through analytics. If you are seeing now after 25% you short, it does not make any business sense sometimes. It's all about shorting when it's spiking, then you take a risk also. So those are the inflection points you have to deal with that.
Right. So Sandeep, just to summarize, so you have 20% which you will more or less run unhedged. That's your strategic allocation, and the 80% is
remaining 80% I can hedge only 25% of overall portfolio.
Yeah.
But I will try to play in those names. Okay.
So I'm assuming that a large part of that 80% will be mid caps, because you can't short small
logically
cap.
yes, maybe majority will be the mid and less will be on the small. If you look at out of, we did some 213 stock, nearly 96 are large cap, and then mids are only what, some 25 or 20, no, 18, 19 stocks are there. So if you are right, absolutely largely mid. But we are calling it SMID. It does not make any difference.
Of course, of course.
The only thing is that if I get that option on the small cap index, which you have mid cap index, if you get that option on small cap, that will be even useful
to use as a hedging tool.
Yeah.
All right, Sandeep, thank you so much. We're at the end of our conversation. I hope you guys liked it, and if you have any feedback, just drop it in the comments or ping me on social media. Thanks, Sandeep.